Multifamily thrust once again into the national spotlight as apparently Venezuelan gangs take over an apartment complex in Aurora, Colorado. Well, that's not exactly what happened. We're going to actually get into the details of what happened and what would you do as an apartment owner if gangs of anybody took over your apartment complex, or is this really just a story of bad management and ownership? We're going to get into that and so much more. We had a CPI print from the Bureau of Labor Statistics. Shelter still keeping CPI up, but what does that mean for the Fed's expected rate cuts? Are we going to see a 25 basis point cut or a 50? And then we're going to get a snapshot on the markets. Major players, again, saying it's time to get into the multifamily space, going all in as they see supply reducing over the next several years and rental inflation expected to increase. So a piece from Colliers, a piece from Market Watch, and then we're going to be checking in on Green Street, their commercial property price index, seeing the strongest sectors of commercial real estate price appreciation or declines over the last month and over the last year. And then some snapshots on where the fundamentals are right now from Apartment List, Yardi Matrix, and RealPage. If you're a multifamily investor, you're in the right spot right now. Every single week on the Gray Report, we break down all the latest research reports, trends, data, and throw out some original opinions related to the multifamily industry, commercial industry, housing, and the macro economy. So strap in. I'm joined by Director of Communications and Marketing here at Gray Capital, Matt Bosnagel. Let's get into it. Welcome back to the Gray Report. Well, Matt, how's it going?
Pretty good. How are you
there?
Oh, yeah, hanging in there. Yeah.
Good.
A lot of good stuff this week.
Oh, man, Matt, it's incredible. So we decided to cover this piece that's been in the mainstream media about apparently the Venezuelan gangs that were taking over this apartment complex in Aurora, Colorado. It seemed kind of a little bit crazy at first. It sounds like, since the story came out that I think the story got overhyped a little bit and kind of got fed into the presidential election narrative and kind of media hype related to kind of immigration. But man, when I first saw this article or the story, I guess, I mean, the first thing, regardless of whether it was true or not, all I could think of is like, that would be an issue to deal with.
I know. I was thinking like, practically, what's the next steps here? And
what do you do? And I guess that, there were reports that like the Hells Angels and like these like biker motorcycle clubs were like teaming up to go and like, take down the, clear out the apartments and take down the gangs and.
Jeez. Oh, to go against the gang.
Yeah.
Oh my goodness.
Yeah.
Well, I'll just read the quote, which comes from this. So,
Okay.
So in essence, there are these reports that this gang has come and taken over the Whispering Pines apartment complex in Aurora, Colorado. And their law firm that represents the lender for this property has reported to police that, quote, the evidence we have reviewed indicates that gang members are engaging in flagrant trespass violations, assaults and battery, unlawful firearms possession, extortion, and other criminal activities, often targeting vulnerable Venezuelan and other immigrant populations.
It's bad when it's the lender's legal that's filing the police report.
Yeah, that's a good point. And
it seems like the chain of communication was lost in responsibility.
Well, exactly. Not only chain of communication, there's just like several missing links. It's not like we forgot to call you. It's like, it seems like, and you said you looked them up on CoStar, and it seems like maybe there's some mismanagement.
Yeah, I looked up the property on CoStar, and I think they're in the process of default right now for obvious reasons, because apparently, the story was, who knows what the story actually is, but that there were gang members that were extorting residents, basically taking 50% of the rent money, trying to collect rent from residents. It seems like also a case of just absentee management, and where are the owners, where are the property managers? Certainly they should have. You have a responsibility to take care of your property, take care of your residents. And
it doesn't happen overnight.
No, and as I think you mentioned, Matt, in the notes, this had been going on for a while. And looks like the whatever supposed takeover started in 2023. But again, I don't think it was the perfect community. Just prior to that.
Yeah, I do wonder, like, so practically, So gangs get 50%. Are they going to report that? Are we going to get a rent roll for that and documentation?
It's on the T12
from a practical perspective. That
security.
If they, it just seems it's kind of ridiculous. And that's what, and so I wrote this whole thing about like, oh yeah, haha. It's like a joke, but it's ridiculous and it can be probably pretty scary. What I do want to say though is it's not like this stuff doesn't happen in some scale.
That's
in the apartment
absolutely
industry.
true. Yeah,
and like you talk to anyone that's been in property management for more than several years or even a year, probably they see everything. You see some gruesome stuff or just like some really dramatic stuff, and the important thing is you respond to it correctly and quickly. And there's little indication here that the gangs just rolled up overnight and started demanding 50% of rents.
From what I understand, and I guess correct me if I'm wrong, it wasn't like the gang is sitting in the property manager's office, and they were like running the place and they had taken over. I think there was one video that was caught on camera. I think that there was definitely gang activity at this apartment community. But there was one documented instance where some gang members were like armed, they had rifles, and they were knocking on the door and asking for rent money. And so that can be a one-off thing that could unfortunately happen in a lot of communities. It's basically just they're getting robbed or extorted.
I know,
and they're just saying like it's basically
it's rent money.
Yeah, they're basically like giving me your lunch money.
Yeah, that's what I was thinking.
It could be anything. They're basically saying you've got some money. All right, it's here.
Yeah.
Pay us, and who knows if they were saying they were providing security or whatever. Probably not. I think they were just extorting. And
you don't have to trick. You don't have to trick people. You've got a rifle.
Yeah, you don't look like the property manager.
Yeah. That was what I thought when you initially said. I was like, well, yeah, rent money, but like it could be any money. You got a rifle in your hand.
So I think the media got a hold of this, and again, what I read is that like there was more media there than gang members, and it kind of turned into a circus. And again, it's this whole story of making it seem like there are Venezuelan gangs that are taking over all the apartment complexes.
I think that the ultimate takeaway that I had with this was if you've got a problem, deal with it as quick as you can, especially if it's these huge problems. And it's hard for me to believe at all that the problem as presented in the past 2 weeks or so is not a result of like a year or most of the year.
You've got a duty and responsibility to, at least that's my perspective. But there are so many great owners and so many great property managers, but unfortunately there's also a decent amount of bad owners, bad landlords, bad property managers that either are negligent, they just don't care. I think a lot of them are completely ignorant of the situations on the ground.
If anything, it's a ridiculous,
delegated away.
It's a ridiculous situation. It does seem like they're like pirates or something taking over a block or something. Yeah. But there's like this dramaticness to the story, but it is a serious issue in that like there are risks that you have to mitigate in property management, and to do your job, it means protecting the security of the community. It means paying attention every single day, reporting things that you have to report, and following what is actually a longer list of like best practices than you may assume. Like you talk to our director of property management, is like, yeah, if XYZ happens, no, that's a good point. This is what we're going to do. We're going to do ABC. And to just let things either fester
or... They bought it on a bridge loan.
It's a good question. We'll
2020
pull that up. Yeah,
I should have. I didn't look at the loan information other than it's they're in default. All right, Matt, I was going to, and I'm sorry, I'm kind of pulling an audible real quick because we were supposed to talk about CPI and inflation, and we're going to talk about that. But man, if I was watching or listening to this right now, and if we went from Venezuelan gangs to CPI, I think everyone will stop listening. So what we're going to do is we're going to talk about basically how major players are getting back into the commercial real estate market, and they're really going all in on multifamily.
So the quote here from PGIM is, "The tone in commercial real estate outside of the office sector has dramatically improved over the summer, prompting more investors to kick the tires on potential investments." I think that That's exactly what we've been saying, especially over the summer. Like over the past week, we've seen this inflection point. It's kind of quarter to quarter, and really even within the last month. That was kind of the quote from 2 or 3 weeks ago on this very gray report, and they are noticing it. And I think the tone is different in what we're seeing recently. So for the past year, what we had heard a lot was, oh yeah, we're all interested for the greatest deals that you've ever imagined.
Yeah.
A lot of dry powder available for the most spectacular, returns that they were looking for, the needle in the haystack that never came. Well, now there is a kind of general activity, and I don't know if it's dry powder or if it's just in institutional investors in general, but like the big money is starting to get back into the market.
Well, I think people realize the deals have already been had, and there's no absolute monster deep discount, fractions of a penny on the dollar. Again, discounts 15, 20, 25%, maybe 30% on some assets that were acquired over the last, year or so. Yeah. But, the treasury is at 3.6%, the 10 years at 3.6% today. Yeah. It makes it easier to buy multifamily. We can see that we're past the hump of, 40-year peak of supply, and vacancies are like holding up relatively steady. Not that we haven't seen major rent declines in, metros like Austin, but, again, we're kind of through that. And this, wall of loan maturities has been kind of spread out enough of where, there are some defaults coming, but it's relatively manageable. Yeah. And there's not a lot of folks that are like, cranking, huge cash on cash numbers, but like people are getting along. And so there's this realization that like, this is kind of it, and interest rates are going to go down more, and there's going to be higher rent growth, and the prices are probably going to go up later on, and so no one can really see the fundamentals that would force values to decline. And then as we're going to talk about let's just talk about the Green Street piece. Yeah,
so so that was just a quote there, but the hard numbers do support what we've been saying too.
Yeah, absolutely.
So that's the actual chart there, and then we've got the report that they issue.
There we go.
Here.
So again, we look at this every month. This is breaking down different sectors of commercial real estate and apartments. Which is this an orange color, Matt?
That's a green color.
That's green. I'm colorblind. Appreciate it. So this green color. You can see the slope of price increases that apartments are seeing right now, and looking on their index. Apartments are down 20% from the recent peak, but over the last 12 months, prices are actually up 2%. And over the last month, there's a 3% change. Yeah. So a lot of interest in multifamily. This is cap rate compression. Apartments aren't getting any cheaper. Yeah. And this is being met with all the anecdotes from market participants saying like we are going all in on multifamily.
The month-over-month increase was higher than the year-over-year. That really shows a short-term increase, that will likely, we're thinking, continue. But it's worth noting also that that positive 2% for apartments, if you look at all properties, they're actually at negative. They're still negative 3% year-over-year.
Good point.
Short-term gains were nice, 1.6% for all property, but nothing compares to the recent growth of the apartment market. I still think, CRE as a whole is 19% down from the peak. Apartments are still 20% down for the peak, but that pales in comparison to office properties, which are 37% down from the peak. They've got probably the most runway, I guess. To make up for there.
So again, not just is the anticipation that prices are going to continue to go up. There are folks that are been in the market right now. Gray Capital, just that we've talked about a couple weeks ago. We closed on a property. It took us a while to finally actually close, but we got it closed. Large A-class deal here in Indianapolis. We bought a property earlier in the year down in Evansville, Indiana. Kind of a mid-'80s, a little more of a value add project. At the time, people were saying, are you guys, are you guys crazy getting back into the market right now? There's a lot of uncertainty. I think, and this is the value of the Gray Report, not just to, toot our own horn a little bit, but I think that, by covering exactly what's going on in the market from different sources, really trying to get to where the truth of the fact is, or just trying to make sense of it from a variety of, different sources, different opinions. having a really good sense of the market, I think we saw the opportunity kind of in front of us. And so I think that's why we made some of the decisions we did. And I'm glad we did because, I think that in retrospect, again, knock on wood, we've got a lot of hard work to do. But from a pure acquisition basis standpoint, I think that we're going to see these as absolute steals, the deals we just did.
Yeah, and it's hard sometimes if you're just dipping into the news and not. But we've been following some of these trends, and it gets easier to find articles. So we'll start a trend and we'll say, it looks like people are getting more interested. And then the next week we'll see a bunch more articles. And sometimes it seems like that hypothesis doesn't work out, where it gets harder to find the articles, or it gets harder to find the research.
Well, you don't want to look for confirmation bias also.
Yeah. So we're a little bit sensitive of that. And I'm also sensitive to the fact that, looking at another article from this short report from Colliers, they're not as confident in the apartment market in general. Now, they're still noting that major investors are returning to the market. So as in general, they're saying, here's a quote, major investors are back in the market, bidding on properties and acquiring portfolios. Statements from investors support the idea that now is an ideal moment to acquire commercial real estate. At the same time, private investment has kept the market moving. Near record reserves are waiting to be deployed. And with investors looking across the capital stack on both the debt and equity sides. We can continue that quote. I will have that in the notes, but it does seem like this is a very, a much rosier picture. They don't say this every month, and it is an inflection point that they're likely marking. I was interested in that for multifamily, they're projecting improving fundamentals and growth, getting back to closer to 4% by the end of the year in terms of rent growth. By the end of next year.
Yeah, Q4 2025 looks like. Well, Q3 2025 will be just below 4%.
I think that actually I think they're a little bit optimistic about their rent growth, especially by the end of the year. I think it'll be closer to 1 or 0 than it seems like they're landing at closer to 2 by the end of the year, 2% rent growth. I think it's going to be closer to 1.
Just for the quarter.
Oh, okay. Well,
not necessarily.
I'm not even sure that we would get that for the quarter. Mm-hmm. I just think they're a little bit rosy. So we'll talk about the apartment specific reports, but this is a case, and it just gets more clear. This is another flavor of the snapshot don't look good, but the prospects look better. We have more information here, and Colliers is saying a little bit differently. So it has a rosy view of multifamily rent growth, but it does not have as rosy of a view when it comes to multifamily pricing. They're saying their forecast for price is flat, and their record for the past quarter of rent growth is a little bit down. So if you look on the top, they have these little arrows because this is a little bit of a snapshot report. Their asset values, office went down, industrial up, multifamily down, retail up, hospitality down. That's just what they said has happened in the last quarter. Now, I think that multifamily has actually probably gone up in pricing. If you look at the Green Street data, they have multifamily, the bottom of the market, really happening in January of this year. However, the Colliers is a little bit different. They say that the bottom has, maybe the bottom is right now, because they're saying that the following quarter is going to be flat.
Well, I can tell you right now, not to repeat, but a 3.6% handle, a 3 handle on the 10-year treasury is getting people back into the market.
Yeah.
And I can just tell you anecdotally, we are seeing major players getting back in, making bids, and paying up. Whereas just a month or so ago, Matt, prop bids were coming in at whisper, below whisper on prices on deals we are going after.
Yeah.
We felt like we should just put in a number where we felt comfortable buying it because we were getting much closer than we thought. That's how we won the last 2 properties that we were able to acquire. Is like, hey, let's throw out a number that's like a make us buy it.
Yeah.
And then we were able to get that number and let's buy it. We're so excited.
Yeah.
No longer is that the case. I mean, property we pursued not too long ago, went a couple $1 million over what that whisper price is. Mm-hmm. And, I was talking to a lot of brokers just this last weekend at an event, and, where during pre-pandemic, I was having a conversation with some brokers in Indiana. They do more deals in Indiana than anywhere. And it used to be, they'd land right on their whisper price. We're gonna list it for 50, and we're gonna sell it. We're gonna tell you we're gonna sell it for 50, and usually they'd be right around there.
Yeah,
like surprisingly. And we're like, wow, the whisper's high, but like, could you get to it? And whoever got there got it. And then during the pandemic, though, all of a sudden there were so many bidders that it was going millions of dollars over whisper. 10% over whisper. And then once interest rates started running, all of a sudden it was 5, 10, 20% below whisper.
Yeah.
Because
that didn't happen as quick as people wanted it to do.
No, and because we were throwing in numbers that made sense to us from a return perspective. And at first, brokers were like, that's ridiculous. That's so far below. That's insane. Because they were still using, 4 cap projections and just 25% rent growth over the first 2 years. And we're like, that's not happening.
No expense growth.
Yeah, exactly. There's 10% inflation, but they're still using 2% expense growth. And so none of that made sense. But then all of a sudden, the brokers they changed their tune and started at least admitting that our underwriting was correct, and they're like, "Yeah, I can't argue with you." So they didn't tell us. But the seller, has in their mind that they want to sell it for. And these brokers, they had given them sellers, they'd given them a broker opinion of value, BOB, that says, "Hey, I'm going to sell this for $50 million." That owner, and this happens because we'll do it. It's natural to do. When someone tells you a number that you like, that sticks in your head, and that's what that property's worth.
Yeah,
now,
I see on Pawn Stars. Well, you told me it was.
I heard. I bought it for
$1,200. That's how much I want it.
Yeah, until they have to wait for the expert to come in and actually tell them. and in this case, the brokers are the experts. And they're saying I can sell it for $50 million or whatever.
That's interesting because I kind of thought a little bit was on the buy or on the sellers that were like, well, I want as much. Can we do more?
Well, they do, but the brokers are giving them this affirming number. And also you have to think about brokers are trying to win business. You're getting solicited by 5 different brokers or brokerage shops, and maybe exactly who you want to work with. You have a relationship with someone. If you're doing a lot of business, it's good to have relationships with a lot of brokers and to manage those relationships, which is easier said than done sometimes. But so if one broker, just because they're trying to win your business, this happens, they'll overinflate what their value is just so they can win the business. Because when they come to you and they say, "No, I can sell that building for you for $55 million."
Yeah.
And the other guy's saying 50, and it's like, do you want 50 or do you want 55 million?
Yeah.
I'll take the $5 extra million. Yeah. And so they give it to this, and they give it to this guy, and they're excited. They're almost like, spending the money like they've already sold the property.
Yeah.
And they're like, this guy who is an expert that I trust, apparently, told me that number. So it's way overinflated than it even should have been, because the guy's just trying to win business, but also the market's crazy, so who knows where it's going to go.
Yeah. So,
then the opposite happened of where the sellers are still holding on to those high numbers, but they finally have capitulated to understanding where the market is, which is 20 to 30% below that.
As these different parties kind of come to the shared realization, it looks like, and it's interesting too that they came to this, and then it started the momentum of people getting a little bit more competitive because the activity started. It's an interesting confluence.
All of a sudden, deals were trading for, instead of the 50, 40 million.
Yeah. And that was at a time a little bit before it was like guaranteed that we'd get rate cuts. It's kind of a little bit of a confluence of.
Well, I feel like the floor was starting to be, it was being kind of set of like, all right, again, prices have come down, call it 20% or so, 22% according to Green Street. Yeah. And which was like, man, that's $15 million below what that broker told me I was going to get. But, I still was able to break even, or I was able to make a little bit of money because I bought it. Okay, well, I bought it for 30. Okay, I can still sell it for 30. I just thought that I was going to sell it for 55 and make just some stupid amount of money that was going on for a while. But now but all of that activity was going on when, the 10-year treasury was upwards close to 5%. Yep. And there was uncertainty, to your point, and no one knew what they wanted to do. And equity was on the sidelines, and just uncertainty. Now, I mean, we're getting it. We're hearing it from our equity sources. I mean, we've raised almost $50 million this year, and we could not have done that if if folks weren't interested and ready to go.
Well, that's what I think is interesting too, because there's a challenge in finding the right deal, and there's a little bit of a timing of, all right, we got to wait for the prices to be good, but when prices are good, it's a little bit harder to get equity too. It's harder to convince investors. But as the time is
run when everyone's running one direction, you're running out away from the fire, you're running towards the fire.
Yeah, so it just makes it harder. You got to tell that story to investors.
Yeah, no, they're running away from the fire, and you're saying, no, on me, let's go towards it because this is a great opportunity.
Yeah,
and they're like, what are you talking about? We're actually, I don't know how many conversations I've had over the last year or so where it's like, actually, we're going to be reducing our real estate exposure right now just because, we're not sure about it, and we're getting decent yields in private credit, which, you can get some decent yields in private credit. Like, that makes sense, but, you're going to be missing out on an incredible, growth opportunity in equities because they had a 6-month lag of being like, well, I can only get like 12, 13, 14% on a multifamily deal because prices were still really high. They're like, so like if I can get, 10, 11, 12% on, preferred equity or private credit, that sounds pretty good.
Yeah.
Then all of a sudden it's like, well, no, we're actually finding deals where you can get 15, 16, 17, maybe like 18% IRRs, without a lot of any rent growth. And I could paint you a picture where we're getting a mid-20s return. That starts getting exciting, but it takes a while to shift, to say, go from, everyone's a little bit delayed.
Yeah.
People were overpaying for deals in 2021, and that's when they loaded up. And so they're like, I bought a lot of bad real estate.
Yeah.
Or I paid, maybe it's good real estate, but I paid too much for it.
Yeah.
I'm like, all right, well, now you need to fix that cost, basis, average out that cost basis.
I wonder if even though the deals will be, won't be as good as they were in the past few months, I wonder if it'll still be easier to get investors. It's just kind of the way it goes. As the overall investment climate, now people are getting more interested. And
we were just having conversations with a lot of our investors last week or so, just kind of touching base. And you always wonder that of like, all right, we just did a deal. Is everybody good?
Yeah.
How many more money to even invest? A lot of investors have pretty deep pockets, but sometimes still you're kind of tapped for the year, you got your allocation, and not almost universally, people were wanting to know when the next deal was.
Yeah,
and they're ready to go.
Yeah,
so
that's you wish it was always easier to get these. You wish the money was always flowing in and.
Well, now it's hard to buy deals. Like like we could have, like there were probably deals we should have bought over this last year or so that were just weren't confident maybe on the equity raise. Now maybe we're a little bit more confident maybe, and it's a great time to buy. But it's harder to make. The deals are more competitive because there are more buyers and they're bidding them up, and cap rates are compressing a little bit. Rates are coming down, but at the same time, there's an apprehension to really understand how much rent growth we're going to see over the next couple of years.
Yeah,
I was going to say we're biased for lower growth right now, just because we're like, hey, look, uncertain times, we've had 2 years of low growth. Like, what are we can't put in anything above what just is today that's organic of maybe 1%, 2%, 3%. But then when you look at it, and I see supply coming down, and I look at some of the forecasts and projections, I'm like, it's projected to be nationally. I mean, we're looking at the projections of around 4% rent growth by the end of 2025.
Yeah.
And so I'm like, and in some markets, it's going to be higher than that. We have some of our properties that are doing 10, 15%, trade out still today, in certain markets. See supply really fall off a cliff. It's like, I could see some really strong rent growth in the next couple of years. I think we may have a year of relatively kind of slow normalization before we get there, but we still have a lot of supply to go through. But just apprehensive to really bake that into a model.
Well, and talk about apprehensive and kind of risk and uncertainty. This is a moment where it does pay to look around and like we again, I'll mention again, like the snapshot doesn't look good, but if you look forward, then things could be better. But this is where it really separates, the wheat from the chaff, I guess, is what are you predicting? Are you predicting 5% next year?
Yeah,
because that could really be horrible. My guess is that most people have been a little bit chastened, if not a lot chastened, by the anemic rent growth that we've seen the past year, the really low rent growth. So they're not going to really be hugely optimistic.
Yeah.
That's going to change quickly.
Here's the way I see it. The deal needs to work on those anemic growth assumptions. It needs to work with slow growth and relatively high expenses. You need to be okay with it. But it's not going to look that great, and you're going to see probably pretty slow cash flow in the first year or 2 years.
Yeah,
I think that's reasonable. And again, I think the next year is going to be relatively slow. Then I think it's going to pick up. Now, I think that we will, like Great Capital, knowing our operate, like we're going to crush those numbers. We're going to crush those performers, and I could probably show another pro forma that like what I actually think is going to happen. But I don't really want to talk about this.
Yeah.
Because there is speculation, but it's my gut. And I've done this enough times and close enough to it. I'm very confident that that's what's going to play out. Maybe not exactly, but like that's definitely the direction. And this is kind of not even a worst case. Like this probably isn't going to happen, but like this is what we have to assume to be okay.
Yeah, because you got millions of dollars, and you want to serve your investors, and that's a good framework. I do think there's still a lot of opportunity for people to make these kind of thoughtful speculations and understand where each individual market is going. They're going to be filling up. I think that it'd be interesting. I don't feel like there's a lot of sales that happen that get started, near the end of the year. But
it's a mad dash. I mean, there are a lot of folks right now that are trying to put deals under contract. I mean, I'd love to get another deal to close before the end of the year. But realistically, again, especially if you're not as familiar with the process, the bidding process on a multifamily property can take 2 to 3 weeks.
Yeah,
people put in their offers. The offers get reviewed on Monday. They talk to the seller, and then they send out emails, and maybe another round of offers will be due. Maybe the bunch will be narrowed. Will be due the next week, and then maybe a best and final the next week. Maybe it'll be right after, but it's that 2 to 3 week process. And then they usually choose a buyer, and then there's some back and forth on like the LOI. And sometimes that's right when it's chosen. Sometimes there's still some back and forth.
Letter of intent, is that?
Letter of intent, LOI. But these are the general terms in which we're going to do the deal. This is how much time we need, et cetera, et cetera. And then it can take anywhere from, trying to think of the quickest PSA negotiation.
So like from where so they put it on the market, maybe 4 weeks later, you've got the LOI signed?
Oh, no. You put it on the market, then you could have easily 6 weeks of marketing, and then offers are due.
Oh, okay.
I mean, maybe 4 weeks of marketing.
Yeah.
Call it for just to be generous.
Yeah. So a month. So it's on the market.
Days.
Then you got a month, and then how long does it take to nail out this LOI?
Well, the bidding process can go on for 2 to 3 weeks.
Oh, okay. So now we're at 6 weeks. Let's just say
6 weeks. 6
weeks. They picked you, but you still have to hammer out that LOI. Is that
now you have to do the PSA, the purchase and sale agreement.
All right, I am like back to the drawing board.
So that takes longer than 2 weeks.
Yeah.
So you're at 8 to 10 weeks.
Okay.
Until you're under contract.
Wow.
And then it's 60 days to close. Usually from signing a PSA, but often it can be extended out to 90 and even extended out to 120 days before it actually closes from that point in time.
Yeah, it's like 3 or 4 months, and that's realistic, kind of. It's not overblown according to the ranges they gave me. Wow, that's a lot. And then I was just thinking of this when you talked about someone that overpromises a bigger prices, so they maybe promise $65 million for something that's worth $45. And then
just think about any other type of publicly. None of these aren't publicly traded, but like prices move, and this is why real estate moves so slow, is because that's how long a transaction takes.
Yeah.
I don't know how many times you're in the middle of a transaction and like the price is going one way or the other.
Yeah,
and it could be good or bad.
Yeah, well,
I've experienced both.
Yeah, as interest rates move, sometimes it's like it behooves. It's like your duty. I think
we've had to do multiple $1 million renegotiations or retrades because the interest rates have increased a full percentage point.
Yeah,
it's not worth what it's worth our returns don't make sense, we'll lose $1 million to back out of this deal because we have earnest money, but we have to back out of the deal.
So,
but you're not going to be able to get a better buyer in closing times. It takes so long, and the prices might even be lower. So your best bet is to still give us a lower price and get the deal closed.
That's what I was wondering, actually, too. If someone overpromises a high price, they don't get that price. No one wants to buy it. They give the bids, and then the seller, and then is the cost to the seller just like the broker spent all that time selling it. Usually they take a piece of the...
Broker don't make any money.
So the broker don't make any money. The seller doesn't sell it. And he wanted to sell it. They just start all over again with...
They have to decide to go back to the drawing board.
Yeah.
Do we list it with somebody else? Do we refinance it? Do we keep it?
Yeah.
Depending, what is you might have a loan expiring.
And I'm not saying that there's no penalties in that situation, because time is money. We've seen, with this 4 months of, with how long things...
No, the penalty is the relationship.
Yeah. Okay. That's really interesting. All right. Whew. I'd love to, I was talking just this week, and I was like, well, so, there are real estate. They like to talk, people like to talk about this kind of stuff. And it would be easy to see the ripple effects of, some guy that overbids for a lot. So I'm sure that it's self-policing to some extent. Like, that reputation gets formed very quickly.
Yeah. No, if you, and people do earn reputations, but like the best reputations are, they're like, their BOVs are pretty high, but they get them.
Yeah. Yeah.
That's the best reputation, is like, they told us they could sell it for more than we thought, but they got it.
Yeah.
But if you're known for promising X and delivering, X times, 0.8, doesn't sound that great.
That's no, I think it's a corollary for investors too, but I think it's super interesting to know about all these different, the kind of bureaucracy that you have to pass through, and how long it takes just to buy something. It's really expensive, I guess, that would justify it. You can buy half.
Well, that's what's crazy is, you go through this whole process, call it, 120 days. I mean, Solana, we put under contract 1st of May, May, right? May-ish. Yep. So May, June, July.
Yeah.
So 4 months.
Yeah.
Basically 180 days-ish we've been working on it. And you get it, you close on the property, and all you want to do is celebrate. Yeah. Because it's like, there's so many ups and downs and challenges, and you get it across the finish line. But at the same time, there's this feeling of, it's like, oh, we really can't celebrate. Like, all right, we got to get to work and do the actual thing that you've been planning on doing now for 180 days.
Yeah.
And, but you still have to celebrate, because it is a lot of work. And but I tell everybody, it's like, well, I mean, we could just wait to celebrate for 5 to 7 years, but we might not sell for 10 years. So I don't want to wait 10 years. You have to celebrate you have to stop and celebrate the small and medium wins along the way, and learn from mistakes. Okay. Multifamily market fundamentals, apartment list. We love it. You love it. They have a great report. And
sets a tone really well, I think. It's not a great tone, but in much the same way we talked about last week, I do have a point here. And I talked to this is the same conversation I was having with this person. And we talked about this last week. If you have bad news to give to investors, it's probably good to tell that to them early. You're not going to talk about every leaky faucet, but if every single faucet is leaking and there's a serious problem with the plumbing, you tell your investors. So I'm not going to sugarcoat this. Rent growth, investors aren't going to be happy with it, and I don't think it's going to improve. Just
investors, Matt, are big. Investors are adults.
Yeah,
they're big boys and girls.
That's right.
One thing I've learned about communicating with investors is investors are educated. They understand that things don't always go according to plan. Mm-hmm. It's all about how you address the issues, and you can't control
the solution.
We can't control national apartment rents.
Yeah,
Matt.
And I think. It is good to have probably like a response, an actionable response that to something that you bring. That's probably good for business in general. But I do want to be clear here. I was wrong. I predicted 2 or 2.5 rent growth by the end of the year. That's what I predicted in January. I was wrong. I think it's going to be closer to 1, maybe 0. The point is, based on this apartment list report, now it has the lowest of the 3 that we're going to go over. Their rent growth currently is negative 7% year over year. And seasonal rent growth, traditionally, you don't see much rent growth after August, and month over month rent growth for August was -1. This is almost exactly as it was in last year, in 2023. The only problem is the back half of 2023 was it saw rent declines that were much stronger. So the declines were worse than typical pre-pandemic declines. We will see if we have a shallow declines or deep declines, but it doesn't look good if it's the first half of the year almost exactly the same as last year.
CPI said rents are growing.
Well, yeah, exactly. We can touch on that very, very briefly, but this does fly in the face of CPI, and
The only thing it's good that we report on like the actual numbers, what's happening.
Yeah, I know.
Those 2 points.
It's a good point. Numbers. It's a good point, and we will see the similar numbers from RealPage and Yardi Matrix. They both kind of have a little bit different stuff to add, but they all add up to essentially rent growth is flat for the year. Oh. And the interesting point here, especially with apartment list, is if you look at the back half. During 2023, during the winter months of 2023, we were still dealing with a growing amount of newly built apartments. We have crested. We're at the peak. So the back half of this year, to the winter of this year, we're not going to be dealing with ever increasing newly built apartments. So there is room for a little hope. However, if the trends are the same, you have to expect rent growth to be maybe -1 this year. It's not. It is a sobering fact. But
winter is coming.
Yeah, winter is coming. Yeah,
winter is coming.
I think also I wonder too is, do you think apartment operators have a hand? I'd like to think they have a handle on expenses, or expense growth has not been as severe this year than last year. But I also do want to note this is good news for renters. I set this whole thing up talking about bad news.
Well, no, but I thought RealPage was controlling the rental market, Matt, and we had to institute price controls.
Yeah, I don't know. It doesn't look like that according to all of this.
Doesn't he? I thought the algorithm was going to make it go up because of collusion.
Yeah, I don't know why. I don't know why it hasn't. But I also know that
the Justice Department is spending time on it.
I guess. Well, and this is my point too. Is like I also am aware that like not everyone's an investor. This negative 0.7 year-over-year rent growth, that's great for renters. I set this whole thing up talking about reporting bad news and all that kind of stuff.
But good for the consumer.
Yeah. It's good for the consumer, but it also represents the dynamics that are at play, which it's not algorithms at play here that are making that are defining the rent apartment market. It's newly built apartments. There has been a record growth of newly built apartments, so rent growth has declined as a result. There's still some housing demand.
But it is important to mention, as we always do, you usually try to do, that real estate is hyper-local, and we're talking about national figures, and there is a continuing divergence amongst different regions. With new supply, according to our apartment list, new supply is driving falling rents in Sunbelt markets, while Midwest and Northeast do maintain positive growth. We mentioned Austin a lot as kind of being the poster child for that negative rent growth. And apartment list has this really nice interactive map. You can see some of the rent growth figures, like Indianapolis growing by 1% this year. Some outlying, like Bloomington, is down negative 1.2%. Don't we know that, Matt? But markets like South Bend up by 0.2. Down in Evansville, what's Evansville doing? How's Evansville? I can't see the cameras in the way.
There we go. It's 5.2%.
5.2% rent growth. Let's go Evansville. Louisville, 4.5%. Cincinnati, 0.8. Again, but we're seeing positive. We're seeing a lot of positive numbers. Yeah. Columbus, 1.5 positive. Dayton, +3. Even Toledo, because they don't build any apartments there, 0.3%. Cleveland, 5.9. They're not building any apartments in Cleveland.
Yeah. You do see a clump of Midwestern apartment.
These Northeast numbers.
Those are
Norwich, Connecticut, cranking at 9 percentage points year-over-year rent change. I mean, again, like you're living in it's a different scene if you're hanging out in the Northeast or the Midwest. Portland, Maine, though, negative 3.3. Portland's got its own issues that they are dealing with. But you go down south, and it's a little bit of a different story. A lot more negative numbers. I mean, Austin, Texas, negative 7.5%. Killeen, Texas, negative 6.2%. Ouch, San Angelo, Texas, negative 2%. Now if we go down here, Victoria, negative 3. Houston, negative 1. Florida, negative. Tampa, we got a negative 2%. So you get the idea. It's a lot different. And what's interesting is this is where most investors were investing, Matt.
Yeah.
A lot of syndicators. I mean, it's Texas, it's Florida, it's Georgia, it's the Carolinas.
Yeah.
Here, we got
they invested a lot and they built a lot, and that's why rents are lower right now in the South versus the North. In general, you look at this map.
Sierra Vista plus 9.9%.
Yeah, man,
wow. That's more of an
outlier.
But that's an immigration story right there. Negative, but Phoenix, that's you got a lot of too many apartments.
Yeah, very very interesting. There and similar, and we get similar data overall in RealPage and in Yardi Matrix. Is these overviews of the apartment market, RealPage specifically talks about the kind of regional differences a little bit that we just talked about. Northeast occupancy is at 95.6 compared to Midwest. However, Midwest rents came out on top at 2.9% year-over-year growth compared to 2.7% year-over-year growth for the Northeast. They also have rents at 0.4%, more or less zero, and the monthly effective rent change was zero. Again, seasonal rent changes usually kick in about now, in that rent growth is going to be slower if history is a guide. They may not be as bad as last year because we are on the other side of we have less newly built apartments expected on the tail end of 2024 compared to 2023, but it's still largely the same story. I'm not going to expect rent growth through the end of this year. So that's why I'm around 1.
Yeah, I mean, breaking news, you're changing that forecast to maybe 0%.
Colba. Yeah.
Yeah. Okay, Yardi Matrix National Multifamily Report for August. We always love these reports as well.
This one, again, they're all the same thing, but I like to pull out a little bit of differences. And Yardi Matrix did a good one pulling out the declining rent growth in lifestyle apartments. So these nicer, newer apartments, has made essentially their month-over-month rent growth was negative 2%, negative 0.2%, sorry. And year-over-year, lifestyle rent growth is at negative 0.1%. Now, that's compared to a positive 1.9% for renter by necessity. So overall, it's 0.8, but there is this big difference. That's just flat dab in the middle of...
I mean, it makes a lot of sense. I mean, logically, if you think about all the new supply, they're not building B-class apartments. They're building luxury apartment, lifestyle apartment communities. A lot of supply of the same thing that's going to drive down prices.
Totally. And the trend is also present for the single-family market. They don't have the specific numbers, but they did note that lifestyle rents are down by... So it's negative 0.4% month-over-month rent growth there. And we didn't get the numbers for other segments of the single-family rent growth, but negative 0.4 is still a decent-sized drop. If you expand that, that's like you could maybe get close to 5% by the end of the year if you total negative 5, total. But
it is interesting some of the difference comparing the apartment list. Rent growth tracker and the Yardi, for example, Indianapolis on apartment list was forecasting around 1%, had rent growth of 1%, whereas Yardi is tracking Indianapolis closer to 3%, kind of sitting in the top 4 spot nationally. I mean, again, looking at completions as a percent of total stock, these numbers across the board are coming down. I mean, we were seeing a lot more numbers in the 4, 5, 6, 7, 8, 9, 10, even 12% range. These are coming down quite significantly. Looks like Orlando still has quite a bit of supply coming in. Nashville, both around 5% respectively. Austin still at 6.2% of percentage of forecasted inventory coming online relative to existing inventory. But these numbers coming down, easing a little bit, and so I think we should see a rebalancing of some of those lifestyle assets over the next couple of years.
Just again, it is interesting to compare all these reports. We saw how Yardi Matrix is about a 1%, if we're talking the national average, 1% higher average rent growth compared to apartment list, and RealPage is about near the middle. So You can collect them all and and make your own decision, but you just kind of know how to. Typically, apartment list has shown a lower rent growth average compared to the other ones. But it's nice to be able to have that context there.
Yeah.
Sure.
All right. Well, make sure that if you enjoyed this podcast, whether you're watching on YouTube or wherever you enjoy your favorite podcast, make sure you should subscribe to the Great Capital YouTube channel. As you check in the other podcasts that we have here at Great Capital, such as The Complex, that does a deep dive into property operations, property management. It's a really great show hosted by Director of Property Management at Great Residential, Katrina Green. But make sure you subscribe to the Great Capital YouTube channel. We've been doing a push recently. We've actually got a couple hundred new subscribers. So if you are a new subscriber to the Great Capital YouTube channel, thank you for hopping on the train. Hope you like what you get. You like what you see.
Can I have 30 seconds? I promise to be quick to run through the CPI.
Oh, we're going to do CPI. Yeah, we teased it. We've got to do it.
Yeah.
I tried to bury it multiple
times. I know. And then here it comes roaring back like a zombie.
Well, Matt, because all I could think, Matt, is that we went from this salacious topic of Venezuelan gangs, and I'm thinking about the analytics, watching YouTube of the people that are going to drop off when we start talking about the Bureau of Labor Statistics and CPI. Now, we know that some of you are diehard Great Report listeners. All right, I'm coming here for the CPI report. Let's break down the numbers. Let's get nerdy with it. But
all right,
we do that plenty.
I can do it. Still going to cover. I can do it quickly.
Let's get into it.
And
this was the tease? Like people sat around this entire long great episode.
It's like they save
the
most exciting stuff for the end of the newscast.
We salute you.
So another month, another consumer price index, another tick downward for inflation. What I noticed, you kind of going through the charts here, is that there was a rough pattern of so if you take the peak, June 2022, all items inflation was at its peak at 9.1%. So for an entire year, and you can see it on the chart here, there's a peak, and then and then it goes down for an entire year. In June 2023, inflation was down to 3%. Now, everyone knows what happened since then. It's been the bumpy last mile of inflation. Inflation in June 2024 was 3 again, so no change. So there was a year where it went down all the way, a year of bumpiness, and now my hope is this year is the year of that last mile, of a more pronounced decline in inflation. And it has happened. I mean, since June, there's been a couple months consecutively of inflation declines. However, the recent trend of declines is longer than that. It just has been declining since March 2024. I think maybe more meaningfully is that we are now at a inflation that is below that previous low of 3% in June 2023. We broke through that a couple months ago, and that gives me a little more confidence that it will continue to decline. So that's my story on overall inflation. The other weird story is shelter inflation. It actually went up. It's been declining. It was a little flat. This is a rare moment because it's been declining for over a year, maybe almost 2 years. Unfortunately, it's confusing. They have not yet recorded the low rent growth that we've been reporting on just now. That's not showing up in the consumer price index because their rent of primary residence is at 0.4%. That's positive when that's not what we're seeing. And also their shelter overall is increasing by 0.5%. So shelter inflation was really supporting a little bit more, a little more strength there, stronger increase. Now, these are month-over-month numbers. The year-over-year numbers for shelter is at 5.2%, and the rent of primary residence is still 5% year-over-year numbers. This is supporting and dragging inflation up. However, it's nice to know that that other aspects of inflation have contributed to declining prices,
and
I
think
it's frustrating.
Why this is so important, obviously, is anticipating what the Federal Reserve is going to do here coming very shortly, making a decision on whether to lower interest rates. We're assuming 25 to 50 basis points. I think now the consensus is pretty close to be on 25. That's what I'm thinking. I don't want to spook markets too much. And with this report, it didn't absolutely give the clear direction, but it wasn't so much of like, all right, we're seeing things falling off a cliff so much, we're at the decline. But you could say you take shelter out of it. You look at maybe that super core PCE deflator, which is the Fed's primary tool to assess inflation, although they're certainly looking at CPI as well. If you take shelter out of it, maybe actually inflation is quite a bit lower, really close to that 2% target. And maybe they should move 50 basis points. But right now it's uncertain. And again, it's not so glaringly obvious where it absolutely need to move. So my gut is they're only going to do the 25 basis points. Nice and easy. Stick that soft landing.
Yeah. I think that psychologically, I think that the numbers I wouldn't count out from a practical, sensible situation of like a 50 basis point. It would be appropriate. But I think psychologically, they don't want to get people too excited. So they can't do that 50 right away, because we saw the most recent jobs report was lackluster jobs numbers, and the ones before that was lackluster and got revised down. So there were 2 consecutive jobs reports that were not great, and then you see also 2 consecutive inflation reports that were fairly positive, continuing a trend. Maybe it's not as quick as some people would like, but if you're looking for reasons, there they are.
There we go. All right. Well, Matt, you were able to sneak in CPI. That was a good one. We'll have to cut it out. It'll just be its own standalone CPI video. No, it can stay on, but it can be both. It can be both. All right, everyone. Thanks again for watching this episode of The Gray Report. If you'd like to learn more about what we do at Gray Capital, you can go over to graycapitalllc.com. And I'd be amiss to not mention that we've got an incredible newsletter. It is the top CRE newsletter, Gray Report newsletter. You can go to grayreport.com or find more information at graycapitalllc.com. All our investments are open to accredited investors only. Screw the SEC. Thank you very much. See you next time.